Hello and welcome to all of our viewers. It is January 23rd of 2023. Crazy to think that just one more week and we'll be already through the first month of the year. Now, what we're going to focus on this week is what's been working in the market so far, year to date, what's not working, how is that emblematic of the overall market, and what we think are the symptoms of what the market is trying to tell us. So we'll go ahead and get started. I'm just going to go ahead and share my screen like I do every single week. And what we see here is, we titled this week's presentation, Letting Go of the Past. And what do we really mean by that? It's not to say not to learn from the past, but it's really to say when we go through these bear markets like we have over the last year, there is that habit that a lot of investors, both professional and retail, have of wanting to chase prior leadership and try to pick the bottom. Oh, technology, I missed it for the last 3 or 4 years. Now it's my chance to get in. And that's where you actually will compound some of those losses, because what bear markets are really around for at the end of the day, because if you think about the S&P 500 has gone up and to the right really since it's been created, right? So markets over long term go upward and to the right. What bear markets are really here for, not to permanently lose people money, but they act as a mechanism for regime change. They act as a mechanism to change the leadership of the market. So we think of the 2000s, we think commodities. When we think of 2010 to last year, we think of technology, cloud computing, social media, the smartphone, those types of mega trends that were really concentrated in tech and communications. We've had a vicious bear market. And guess what? We're going through what we believe is regime change again. And we think this is marked and characterized by, of course, the end of quantitative easing. And we break down the themes in terms of 3 broad buckets that we're focused on. Old economy over the new economy. Over the last 10 years, it's been all about the new economy and innovation and really not having to worry about profits until well off into the future. Now it's about the old economy, free cash flow, attractive valuations, and of course, areas of underinvestment and decent growth going forward. Number 2, rock over paper, physical hard assets over paper or digital assets. And lastly, number 3, international over the US, or areas of the US that have leverage to international economies and international markets. So when we think of that new regime change from 2009, 2022, it was dominated, of course, by quantitative easing, which was ushered in after the global financial crisis to help recapitalize the banks, help keep down that cost of capital. And what did that really mean in conjunction with number 2, which was that zero interest rate policy? That really meant that in a low growth world of zero interest rates, investors paid a premium for companies that could grow their top line by quite a bit. But guess what happens when the overall world starts to grow a little bit more? You don't have to pay as much of a premium for 10, 20% top line growth, because more and more companies are doing the exact same thing. So there's not as much demand for that handful of companies that could execute that from 2010 to 2020. Number 3 was that helicopter money, those free checks, those unemployment benefits that a lot of people received during the pandemic. That was the first instance of those direct injections of capital into people's pockets. That, of course, really fueled the market from 2020 to early 2021. And then, of course, one of commodity abundance. A lot of oil, a lot of copper, a lot of iron ore, a lot of stuff that we pull from the ground. As China slowed and new mines came online, we saw a huge abundance of commodities, which kept inflation under control. Today, quantitative tightening. What does that mean? Instead of the Federal Reserve printing money, they're burning money. In other words, they're bringing the supply of money down. The cost of money is coming up. That means higher interest rates. And then, of course, fiscal tax as the government drains back stimulus. And lastly, commodity shortfalls, whether we're looking at oil, we're looking at copper or iron ore, those inventories are going down to record lows, just as demand may be starting to pick up, especially with the reopen of China. So what did that money printing look like? This is the chart of the Federal Reserve balance sheet. And we can see here pretty stable, growing in line with GDP up until the financial crisis, a big explosion. And so from here, really all the way through the pandemic, and of course the pandemic was an even more massive expansion of money printing, we had the supply of money way up, which brought the cost of money way down, which led to speculative risk on for the better part of a decade. In other words, piling money into innovation to companies with unproven business models, or with companies that have proven business models, but also reinvest a lot of that money toward innovation where really the profits are not going to really translate into anything for the next 10 to 12 years. So this is investors focused on innovation. Why? Because you didn't have a super high return on invested capital hurdle rate during those years because the cost of money was basically zero. So capital was in abundance, innovation was high in demand. That led to that technology outperformance. So of course, that view was growth at any price, US assets over international assets. Why? Because the US is the one market in the world where technology is the dominant sector. The new economy over the old economy. And of course, as investors were piling into the US, they were buying US dollars and selling foreign currency. Now we're in a different era, the end of free money, the end of speculation. Why? Because interest rates are going up. As we can see here, this last little tick here, this is the Federal Reserve's balance sheet beginning to contract as they are burning off money supply. Money supply comes down, the cost of money goes up in the form of higher interest rates. So what does that mean for us as investors as we try to understand what the new investment regime could possibly look like? Valuation is king. We want to identify solid growth businesses, but at really decent prices. That's the first thing. Old economy over the new economy. Over the last few years, what we've seen is actually for the better part of 10 to 12 years, is that old economy stocks have not participated in the bull market. We think that's changing. We think that commodities and industrials and the banks are beginning to catch up to that tech bull market. International over the US, Europe, emerging markets have basically traded flat, in some cases negative, over the last 10 to 12 years. As money leaves the US and goes back home to all these other countries, we think that provides a boost to domestic valuations overseas. And then lastly, gold over the US dollar. What's happening when investors are leaving the US? They're selling US dollars and buying their own currency back. What is gold and what drives the price of gold? The value of the US dollar. So as the US dollar comes down in value, the price of gold should, in our opinion, go up in value, and that should be good for a lot of those gold mining stocks that we currently favor. And we can see that. We can see that we're entering into a particularly new regime. Gold has continued to break out higher despite the choppiness in the market. And one thing we'll want to point out here is the S&P 500 versus gold off historical bottoms. Because the S&P 500 is liquid, has a decent amount of beta to it because it's a risk asset, it tends to outperform gold off the bottom of the market. As the market bottoms in November and here in the early part of the year, notice what's happened. The S&P 500 has actually trailed the price of gold off the bottom. There's two things that tells us. First, we actually think this is indicating a longer-term regime shift in favor of hard assets such as gold and such as commodities over a lot of the digital assets that dominate the S&P 500. Remember that technology and communications are around 40% of the S&P 500. That's an important point when we're thinking, when we're thinking of the overall direction of the S&P 500 and how that relates relative to the price of gold. But number two, it's that headline S&P 500, we don't think is necessarily out of the woods yet as it relates to selling pressure. And to be very specific, we think that selling pressure is still going to be concentrated in those areas of secular growth or those high growth, high PE sectors such as technology and communications, which we really don't have any exposure to at this moment. When we look at the metals, right, we call this Metallica Renaissance. I'm personally a big fan of Metallica, but when we look at the metals universe right now, again, another symptom that this market just is a different market than we were dealing with 2 or 3 years ago. What is leadership right now? What are these stocks that are actually close to 52-week highs? BHP, Rio Tinto, Glencore, Fortescue. They have a thing in common: hard assets, commodities, and generally speaking, overseas markets, right? All of those big forces coming together to act as a secular tailwind for these assets. And the other interesting aspect is how few analysts are positive on these names. We look at BHP, only 33% of sell-side analysts have buy ratings. Rio Tinto, only 36% of analysts. So when you get this agnostic attitude toward names, but the stocks themselves are breaking out and moving higher, that's a perfect setup, in our opinion, for a contrarian move to the upside and indicative of the early innings of a potential bull market cycle. And the last big thing that we're really watching here is the Bank of Japan. So every other central bank, for the most part, has ended QE. The last major central bank that's still printing money is Japan. And notice what's been happening here over the last couple of months. The weekly Bank of Japan bond purchase, they have spent 175 billion US dollars buying their own bonds over since December. We don't think this is sustainable. We think eventually this QE program is going to come to an end. Inflation data overnight in Japan accelerated to the upside. So in other words, how can you continue to print money when inflation is accelerating past 4% in Japan, which has historically had negative inflation? On top of that, the futures interest rates, when we look at the interest rate futures market, much higher than the spot yield of the Japanese government bond market. So we think that something's going to break here. We think that similar to the Bank of England in the early 90s, we think investors are going to try and break the Bank of Japan. And what we mean by breaking the Bank of Japan is that the central bank is going to be forced to end their QE program. How are we playing that? We're doing that through Japanese banks. We think this plays out to massive upside. In our opinion. Of course, we could be wrong, right? But if the first part happens, if QE ends, we think that interest rates go up, and we think this is going to lift the lid of profitability that have been suppressing Japanese banks for the better part of 20 years now. And you can see here, this is just one of the Japanese banks that you look at this chart going all the way back to 2008 and even before that, trading at a deep, deep discount. So we think this is a big moment here for Japan and Japanese financial assets. So what's the bottom line? We think that the bear market has, if we think of the bear market, at the end of the day, it's not there to permanently kill your money. It's there to kill prior leadership. It's there to offer regime change and usher in new leaders and new stocks that can push that stock market higher over a long period of time. 3 big messages from this week's presentation. Metals continue to act resilient. They're breaking out both from a relative and absolute basis. Number 2, that old economy is moving back into growth mode, and we want to take advantage of that when the assets are cheap, not 3 years from now when they're expensive. And lastly, the rest of the world remains attractively valued relative to U.S. assets. That's what we got for you this week. I'll see you again soon. And again, if you have any questions, please feel free to reach out to your advisor. Thanks again and have a great day.